This is in retirement, part 4 in the conclusion to our case study of Barry, the postal worker. This, my friends, is awesome. I love this stuff, and I hope you do too. We're going to talk about Social Security versus Roth versus not taking any distributions versus IRA distributions, and we're going to wrap up what my suggestion told Barry would be, recognizing, of course, that you're never getting around the tax man. You're going to pay taxes. The question is there a way you can minimize those taxes? Part 2, though, of course, is you got to remember, it's not just income tax you got to concern yourself with. All right. So I'm going to show you what I'm talking about here because it's more than just the income tax. And that's, I think, gets overlooked a lot in these discussions. So let's dive right into it. If you like what you see here, subscribe down below, subscribe, and then hit the bell to be notified because we do. I love doing this stuff. So I'm trying to do 4 videos a day, believe it or not. Some people might say it's overkill. Once you start doing it, you love it, you're addicted, man. There's all there is to it. I'm hoping to have 1,000 videos by year end because I love it. And if I could have 1,000 videos by year end, I have a feeling I might be able to help 1,000 people. And it might not be that they call me, but they might say, that's pretty good stuff. Because you never know. I mean, you might get hit by a bus. You just don't know. And frankly, if you enjoy what you're doing, it's not burdening. People say, I say, oh, you're doing a video? Yeah, I like it. It's like, do you enjoy fishing? You go fishing, it gives you fired up. I enjoy doing these videos. It makes me happy. And there's a guy named Gary Vaynerchuk, you might have heard from him. He goes, if you like what you do, keep doing it. And I heard him say that about 2 years ago. And it always stuck with me. If you like what you do, keep doing it. So, all right, let's dive right into it. Enough of that. All right, so 3 scenarios. Let's just go over here and type them. All right, so we got 3 scenarios. I guess okay, well, let me bring up another thing. All right, that's fine. We'll go 3 scenarios for Barry. We got 1, take Social Security early at 62 with pension and no IRA until 70 years old. Until 70. 2, Roth, we're just going to take IRA, just IRAs for $20K until 70 and Social Security then. And then 3, IRAs 50K, of which 20's consumption, 30 Roth conversion, and excuse me, and Social Security at 70. All right, so that's the 3 scenarios. So remember, Barry's got a pension at 20K a year at 62 years old. He could take Social Security at Social Security 20K a year at 62. Social Security is going to be 32.8 at 70. All right, so that's what we're contending with. And his 401k, he's got $350,000 in there, and we're assuming a 7% ROR, rate of return. All right, so that's the setup here. So I'm running 3 different scenarios, and the first one is we're going to do no withdrawals until he hits his RMD time, which is 70 years old. We're just saying 70. It's actually 70 and a half. Don't get caught up in that. When you hit 70, take an RMD. I'm just telling you, do that. Don't wait until you're the following year by April 1st, the following year after you turn 70 and a half. Don't do that. And the reason is because then you have to take 2 RMDs in that same taxable year, which you're doubling up on your income taxes, which again, as you understand, if you watch my videos, the more income tax you pay, the more it can affect other things down the road. So don't do that. Just when you hit 70, take your RMD. All right. So in this case, he has $350,000 in his 401k. All right. He's getting, he's getting 1.07%, so 7% a year because he's not touching it. He's taking his Social Security early. Social Security early. I need to revisit that. Social Security early at 62. So he has $20,000 from his pension, $20,000 from Social Security. He's just let his IRA, i.e. his 401k, just sit there and go up. Here's the taxes he has to pay because he still has to pay tax on that $20,000 pension, and the Social Security was provisional income, which we talked about numerous times here at Heritage Wealth Planning. I'm not going to get into it now, but at the end of the day, his taxes are minimal, $1,000 until he hits 65 when the standard deduction goes up to $920. So as you can see, his first 8 years, he only pays $7,800 in taxes, not too shabby. But now he's got to take his RMDs. All right. So now we have 20,000 Social Security at the age of 70, 20,000 Social Security, 20,000 pension, and 20,000 RMD. And now his taxes start going up to 59, as you can see, until now he hits, when he's 85 years old, he has 53,000 of required minimum distributions. He has 20,000 of pension and 10,000 of taxable, well, not 10,000 of taxable Social Security. It'd be 17,700 of taxable, so 17,000 exactly of taxable Social Security. And now we're starting to get into the area that he might have to pay more Medicare premiums, all right, on Part B and Part D, because that's means tested. Now we're in the 22% tax bracket, so he's going to have to pay, obviously, a higher income tax bracket because he's in the 22% tax bracket. Now, he's been in the 22% tax bracket quite a long time ago, probably right about there. No, actually, probably right about here, because 38,000 is the last dollar until you hit from the 12% bracket. Once you hit 38,000, basically $51, you're in the 22% tax bracket, which does a couple of things. It increases the taxes from 0 to 15% on your Medicare not your Medicare, on your qualified dividends and your long-term capital gains. So you just give yourself a huge tax increase there. Increases obviously your tax bracket as well. All right, so you're paying higher tax bracket, higher income tax, higher taxes on your Medicare. I keep saying Medicare, qualified dividends and long-term capital gains. And then you hit some point right around here, you're going to pay even more on Medicare premiums as well. And in fact, if Barry doesn't kick the bucket at 85, there's a pretty good chance he'll double his Medicare premiums, because once you get as a single taxpayer at $107,000 of modified adjusted gross income, your Medicare premiums double from 134 to 268. Your Part B doubles from 34 to 68. So there you go. It's insane. So not all is what we see here, but at the end of the day, we're just talking income tax. And when you factor in all these things, I've done it all. I'm not going to watch me do what I was doing, which is literally look at all these. I just wrote them down one by one, as you can tell. And then I did 4 or 5 sheets like that. And I just wrote them all down in there. So I'm not going to watch me do that. Or have you watch him do that, because you'll never talk to me again. All right. So at the end of the day, he pays $152,000 in total income tax, because he pays $145,000 from age 70 till he dies at age 85. And he paid roughly $8,000 from age 62 to the age of 70. All right. So now he also leaves a pretty significant IRA of $785,000 to his surviving spouse or his kids or whomever. And again, that's just a significant tax hit. Now, that's a lot of money, don't get me wrong, but let's just say they're going to lose 25% of that, equals this times 0.7. So while it's said and done, they're going to gain $589,000 after taxes, because there is a lien called the IRS. And now this is not including state tax. This is just straight feds. Okay. So that's still pretty good. I'm not going to lie. I mean, he drew out all that money. He's got, $589,000 left over. He paid all of $152,000 taxes. I'm not going to sit here and say that's a bad strategy, not the least. All right. Now, I will say he's still relying on the markets at 7% a year. That always concerns me. All right. So now we're going to go back to Kris's observation, where she said, well, if he took $20,000 a year out instead of the, and let Social Security increase, as opposed to taking Social Security early, and he's not doing Roth conversion. So this will be strategy number 2. And so here, same thing. We started with $350,000. He takes $20,000 out to augment his $20,000 pension, because he needs $40,000 a year in income. And his taxes, as you can see, $3,170 until he's 65 when his standard deduction goes up. So his total taxes between 62 and 70 is $24,580. Now his taxes with his required distributions, because even though Social Security and his pension is more than enough for him to take, for him to live on, he doesn't need his RMDs, he still has to take them out. And presumably he's not giving them to a charity, so we're going to have him pay tax on that. And now his taxes go up here quite a bit. So at the first 8 years, because of the 20,000 he's taken from his IRA/401k, he's taken 24,000 out, roughly 24,580 to be precise. The next 15 years, is actually 16 years, he's taken 125,000 out, and he's paying $150,000 in taxes total. He has a $498,000 IRA, and he takes that times by 0.75, because again, we're going to leave it to his 0.75, and he will be left with 374. All right, so all the options. Now, this isn't quite the worst, because don't forget, he has a Social Security amount plus his pension that's well above the 40,000 he needs. So he's got 32,800 in Social Security plus $20,000 of pension. He only needs $40,000. So what's happened to the remaining of that 11,000, 12,000 bucks he has? He's got 32. He's got 52,800. He only needs 40, so he has 12,800 excess cash that's going someplace. So you can't really say it's only 374,000 left to 599, because essentially he's got 11,000. He's got 12,800, and even if we didn't get any growth on that, 12,800 times 16, he'd have another 204,000 left over. So we'd have to add these two together. So essentially it's a wash, actually. Look at that. That's 300, 570, 580,000, 589,000. I mean, it's essentially it's a wash. Now that's not including any gain. That's just straight principal. 12,800 each year. He's just parking into a cash account, just letting it park. And he does that for 16 years. And is that right? This seems a little bit high. 12,800 times 16. Yeah, that's right. 204,800 plus this amount right here. So it's essentially a wash net of taxes. You're probably still going to be better off in this regard here, because you don't need to rely so much on the 7% you're going to get from the markets. Social Security is going to kick in, and don't forget, you are going to get a rate of return on that. In fact, I'm just curious. So if we did 12,800 and we got that at 7% as well, bear with me just 1 second. Take my trusty calculator, compute. Yeah, now we're looking at, hold on just a second. Boink, enter. Okay. Yeah, now we're looking at 381,000, 381,954. All right, so now we're looking at a pretty significant difference here. So we take this, and we go equal this plus this equals 756 compared to 589 net of taxes. Yeah, so this one, so Kris's thing is better. If all things are in a vacuum, which they're not, but that's what we want to do in terms of leaving the most. Relative to these two strategies, by far and away, Kris's is better. I just use Kris because she says if he didn't do the big Roth conversions, if he took less out to augment his pension income while he's allowing his Social Security to continue to increase at 8%. All right, so let's go to my favorite one, and this is the $20K that he's taken out to live on while he's allowing his Social Security to grow. And on top of that, he's taken another $30,000 out to convert to Roth IRAs. This is my favorite by far, and mainly because look at this. I mean, basically, he's paying $8,669 up tax in the first 3 years, $8,400 until he hits 70. He has $52,000 left in his IRA, and then we just take a lump sum conversion of the whole thing. So in that year, his taxes are $15,179. And his total tax bracket his total taxes are $83,246, and he'll never pay tax again, ever. When you think about it, how do I know that? Because he's got, he'll have $32,800 of Social Security. Now he will have a pension still. I should actually back up there. I forgot. He still has a pension of $20,000 a year. So his total provisional income will be $36,400. Which means $6,540 will be subject to income tax. Add his 20, so he has 26,000. So we got to take his 20,000 from his pension, his 6,540 from his with subject to income tax. So 26,000. 26,540. Subtract out 1,330. His taxable income is $13,240. his taxable income, $13,240. He's going to pay what, $1,398 in taxes. So now we're going to pay $1,398 in taxes for another 16 years. That'd be 15 years, actually. 13. What did I say it was? 1398. Is that right? I forgot what I said. Hold on just a second. 1390. Let's say 1399. So you can pay 1399 for 15 years because we already had the first year of retirement at 70. He took that major distribution from his IRA. And we're gonna, always got to do the equal signs, my friend. Equals 1399 times 15. And so now another $20,000 over here in taxes he's going to have to pay. We're going to add equals this plus this here, which was, where was that guy? Right there. Krakow. And hold on just a second. 20,000. There we go. I guess I just got to calculate these guys. All right. So let's just do a sum. So it's total. All right. We're going to do equals this plus this plus this. So 104,000 in taxes. So he'll pay 104,000 taxes total. And even that, I'd say it's a stretch because, well, whatever. It's just, all this stuff can be, it's not in a vacuum. None of this will come to fruition. Anyway, 104,000 total versus, 150,000 under the Kris strategy, 152,000 under the Barry strategy, under Josh's strategy, 104,000. Now, how much will he have left over in his Roth? And I got, I'm calculating. I'm calculating almost $1 million tax free because we're saying and that's not even including that guy right there, because we're calculating 352,000 by the time he hits 70, and we take that 352,000, we times it by 7% a year because that's the rate of growth we expect with no required distributions whatsoever, and he's going to do that for 15 years, and we're talking. We're talking over $1 million because I'd even add this 52,000. He did the conversion. I know that's a little bit confusing, but let's just say we got $1 million here tax free to his heirs. Not only is tax free to his heirs, his surviving spouse, his kids, they're not going to pay tax on it. They have to pay RMDs. But not only does he paid roughly 50,000 less of income tax, but in terms of the taxes that are due in the future, it's just not even close. So here under Kris's strategy, you got 756. And I'm not bad. I'm just using that so I can calculate it in my head. 756,000 net of taxes to heirs. We got $1 million net of taxes to heirs. And then in Barry's strategy, we have 600,000 to heirs net of taxes. In Barry's strategy, he paid 152,000. In Kris's strategy, he paid 150,000. My strategy is 104,000. There's so much going on here. I get that, but that's just the power of the Roth conversions. And I'm not, look, at the end of the day, what if he got hit by a bus? What if I get all that, my friends? What I'm just saying at the end of don't even forget either here too. With my strategy, I'm still not even using the extra $12,800 he gets because he still has that. He still has $32,800 from Social Security. And he still has $20,000 from his pension. I'm not even reinvesting that. So you have to say he's going to get that $972,000 plus this right here, that 308. I hope that makes sense. I'm just sitting there thinking, the more I run these numbers, the more I'm convinced that doing the Roth strategy, absolutely, I just don't see it. And other than having to bite the bullet on the front end, like Kris was saying. Because you are going to pay $8,669 in the first, basically you're going to pay almost $9,000 a year for the first 8 years. Here you're paying $3,000 a year for the first 8 years. And in Barry's strategy, you're paying $1,000. I can't argue with that. That's a great argument against this. But if you can do that, and also, by the way, I have the taxes coming out of other sources as well. We're not taking the taxes out of the accounts for this strategy. We're just saying you got it in a checking account or something. I don't know. But we're just saying that the taxes to pay this comes from other sources, not the accounts themselves. So that would throw another wrench or monkey wrench in the system. But at the end of the day, for me, it's incredible how beneficial the Roth can be, combining with Social Security, combining with your net returns. and your ending value. I cannot see that this should not be front of the mind for you. Front and center is something to think about. Not necessarily something to do, but something to think about. It's fun, man. I love this stuff. So ideas, suggestions, comments. If you see anything that didn't quite mesh, put it in there. I'd love to hear it. I can do this till I'm blue in the face. So just keep commenting. Thumbs up, always helpful. Share the video if you think other people need to see it. They probably should see the first 3 because it is a series. And I'll name this Barry Retirement Series. That's what we'll name it in the playlist. So the Barry Retirement Series. So if you like it and you want to revisit the other videos, by all means do so. Comment, thumbs up, share. Go to heritagewealthplanning.com, heritagewealthplanning.com. The blogs, the podcasts, and all the videos are on there as well. See you next time. Thanks, guys.